looking at the liquidity risk score, we're neutral. Looking at leverage, we're kind of low. Not even neutral, we're pretty low. Which is suggestive, as we go through more of your work, that, you know, we've got a potentially larger move at play here because we've got very little headwinds.
Yeah. So it's exactly very little headwind. If the positioning was so one-sided at this point, especially around an all-time high, like we got in this one here back in Q1, this was pretty much level with the old 2021 high. So you had old resistance, but you also had far too much leverage and positioning all one way right at the top. So it was just it was a recipe for a pullback. We don't have that now. So it's just, it's very, very muted, which is great to see.
So here's the deal. There's a lot that is different this bull run than the previous one. And what this means for XRP, as we've already seen, is it's getting a lot more market share. First and foremost, we all know XRP has a lot more regulatory clarity, but in many ways, XRP is actually a leading indicator when it comes to price movements. Yes, even leading Bitcoin. Very recently, of course, we had Judge Torres deny the appeal for the ongoing case with the SEC, and this instantly saw the entire crypto market actually take a fall right after this news. Of course, XRP was disproportionately affected because it directly involves XRP, but nonetheless, XRP is starting to become a leading indicator for the markets, and this opens up a lot of different doors and eyes on what the potential is going to be on the upside for XRP when a lot more things start coming to fruition. And we're going to talk about that a lot more in today's video. We're going to talk a lot more about monetary supply and what that looks like. We're going to be going through Raoul Pal's thoughts on this. And guys, you're going to want to listen very closely because honestly, it's pretty shocking what is right around the corner. Let's see what Raoul Pal has to say about all of this, and then I'll give you guys a really awesome breakdown following that, so make sure you stay tuned.
Fantastic. So there's a lot to dig into. And before we start, just observationally, I was out in the Middle East, last month, I think it was, and sitting down with the sovereign wealth funds, and the mandate across the entire region from Saudi to Abu Dhabi to Dubai to Bahrain to Qatar is AI and blockchain. And not just using Bitcoin as a reserve asset, but also building the entire government infrastructure on blockchain, driving licenses, property deeds, the whole bloody lot. So it's it's fascinating to see. And then a lot of people say to me, well, if all of this money's coming in from the sovereigns, that may produce an outside return. And I'm thinking, well, if we're going from 3 trillion to 100 trillion, which is my estimate by just extrapolating out the trend rate of growth, you need larger players each time because the market cap is bigger, right? There's no way you're going to get to 15 trillion this cycle unless you've got bigger players. So it's I don't think it's what people think it is. I think it's just a function of the size of the market. The bigger it becomes, the more that those people are involved, and the more blockchain technology gets used, the more it uses the alts for infrastructure rails for new forms of compute and storage and all the other things that are coming. So I just thought it was interesting because everyone's like, oh my God, it's a super cycle because of this. I'm starting to err towards, well, we've talked about this before, a longer cycle, just because the business cycle is still below 50. So generally it takes a while to climb up. And then we use the GMI Financial Conditions Index, and that has a 9-month lead. And with the dollar breaking down, even today, it's starting to suggest that this may go even into Q2 2026. So it's like the whole cycle got shifted because rates didn't get adjusted and the dollar was sideways for a period of time. So it feels that potentially there is a chance, and again, there's no guarantees in this world, that we're more like 2020 than we are in 2021. Or it's spookily similar to 2017 for me. So let's go through some of your charts, some of your framework, because I think people are going to love to see the work that you put in. I don't know where you want to start with that deck or whatever you think the best narrative are.
Well, I think we could sort of start with just the actual risk framework that I built, looking at global liquidity first. So what I've got here is just my version of global liquidity index, which is, aggregation of, private credit through, global M2s or the global money supplies of large countries, central bank balance sheets, FX reserves, US net liquidity. And
this is similar to our GMI total global liquidity. Yeah.
Yes,
Okay,
it is.
got it.
Yeah. So what's your number roughly? Do you remember?
I don't know actually.
Yeah. Well, it's you can see that there's a very tight correlation. Like depending on the data set you use, the regressions, the R squared or the the explanatory factor of global liquidity on the Bitcoin price movement is very, very high. It's like one of the strongest relationships in financial markets.
Yeah, we get using ours. We get 90%, 88%.
Yeah, and I'm in that ballpark as well. But what's interesting is that that's a relationship, that's a sort of linear relationship over the time period, but there are periods where Bitcoin becomes hypersensitive to the changes in liquidity. We've had these periods where, global liquidity goes sideways, and actually Bitcoin usually tops before global liquidity tops out. So it's
like when the rate of change of global liquidity slows down, it starts topping.
Yeah. Because this has been driven by, in the past, a lot of central bank activity as well. So central banks move very, very slowly, but the market detects when inflation when break-even starts to break high, the market starts pricing in higher inflation, that the central banks will have to pivot. But they don't pivot on a dime unless it's an emergency when they're adding liquidity, but never when they're withdrawing. So usually Bitcoin will sniff it out many months in advance and we'll see the top form and then global liquidity will roll over. But the contraction periods in global liquidity traditionally have only been sort of 24 months, so 2 years, and that was in 2014 and 15, then in 2018 and 19. The one that we've just gone through has actually been 3 years. So to your point earlier about the cycle being elongated, if you look at global liquidity here in white, it's been it was down sharply in 2022, and then we just had this sort of contraction period, like a wedge pattern that we've sort of been squeezing into and now breaking out of. So a longer contraction.
Buying that low in the first, that's what we did, and it worked really well. Back end of 2022, when global liquidity, it doesn't give the strongest price action, but I don't know, Bitcoin's up 6x since then. So it does work just by getting the bottom of it. But the breakout is when it really counts, right?
Yeah. So the tops are harder, but the bottoms are easier actually, because, at the bottom, it's usually sharp central bank actions. And that's the signal. You sort of don't have to sort of second guess that. And now that we're starting to break out, and you look at this sort of breakout of the last contraction period, and obviously 2020 was exceptional, so we're not looking to repeat that. But generally, if you look at the previous times we've come out of a contraction period, that has been what I define as like the super bullish liquidity regime. So, global liquidity can only contract or go sideways for a certain amount of time because the whole system is so indebted that their default risk rises, and also just the interest cost on debt becomes too excessive. So there's always an impulse to add liquidity. And so like a beach ball under the water, if you keep it down for too long, it's going to burst out, and we're starting to break out now. And so in the past, when we've seen a breakout of the previous all-time high in global liquidity, Bitcoin's sensitivity to the changes in liquidity triple, at least, sometimes 4 or 5x. So
wow.
in my analysis, global liquidity goes up by 1%, Bitcoin usually rises about 7%. But in these particular regimes, that goes to 20 to 30 times.
But here's the most important key takeaway from Raoul's and his friend's speech here, and it's that global liquidity is not just a driving indicator for all of the crypto market, it's also the driving indicator for the stock market and even real estate markets. And if you're paying very close attention to when rates are starting to be tightened and they're going up, well, that's a really strong indication as to where the global liquidity is going to be headed. It's going to be going down. And if the liquidity is going down at an aggressive pace, well, so will the price of digital assets. And as Raoul was saying, finding that bottom is really easy, much easier than finding that top. I actually made a lot more money trading in a bear market than a bull market, which might sound absolutely insane because shorting in a bear market is extremely easy. The indicators are extremely accurate, the number of ones that I use, and it allowed me to make a lot of money in the last couple of years. And not to say that we're not doing well in this bull market, we absolutely are. It's just things are obviously very much up and down. And as we can see, it can be easy to get caught up in the longs because you want to get as many gains as possible. But finding that top is actually much harder than finding that bottom. It's so true. So with that being said, Raoul is really going to break down one more crucial thing that all of you guys just need to understand. And then after that, I'll give you guys some more extremely valuable insights in my view that I think will really help you guys out. So with that being said, let's get back to the video. Interesting
is that we got the breakout in global liquidity in early April as the markets were sort of tanking. So that was this low that we went through, which really wasn't much to worry about, like in terms of Bitcoin pullbacks, but it felt pretty nasty at the time. Massively outperformed the S&P, massively outperformed the equities on a volatility adjusted basis, even though, it was down 30% and the S&P was down 20%. On a risk adjusted basis, massively outperformed equities. And so when global liquidity broke out in early April, Bitcoin rallied 40%. Global liquidity from that breakout is up about 2%. That's roughly what it has done in those previous bullish regimes where global liquidity breaks out to new all-time highs. You get a sensitivity factor that is factors higher than it typically is. And so for me, it's interesting that, we're not overbought, based on liquidity. Every new dollar that's created, whether it's even through like the US dollar weakening or depreciating is an easing on financial conditions, it all adds liquidity into the system or makes financial conditions better, and the relationship is strong. And so, I'm looking at now a market that is not overheated at all. In fact, it's doing what it should be doing and it's not doing anything excessive. So I talked about a framework for sort of modeling the risk. What I did was I converted that relationship into a risk score. And the risk score for global liquidity is just this one here. It correlates pretty well to the tops in Bitcoin. So what you want to see, it's a rating system of 1 to 5, but I've also got percentiles, and we'll be publishing them onto the RV platform. So if people want to get a little bit more granular, like if we're at a 4, does that mean we're at 82nd percentile or the 88th percentile, the 90th percentile? We'll get that granularity shown as well. But what it's designed to do is to say, okay, anything below a 4 is sort of just neutral, normal conditions. When we're at 4s, you have to start thinking about, okay, if there is chips to be taken off the table in Bitcoin or crypto.
And this is not necessarily the full cycle top. It can be sub-cycles within, right? Because I'm looking at got to 5s a couple of times, backs off again. So you kind of use it like a weekly RSI kind of idea, is like an overbought, oversold indicator.
Yeah. So what you said is like perfectly correct. It's like you've got to use it with some context. Like an overbought RSI at the beginning of a breakout of a long-term downtrend is not a sell signal, it's a buy signal. But this is a little bit more calibrated to knowing when things are really stretched relative to the one the one statistical relationship which really seems to matter, which is liquidity. So if it becomes extremely stretched versus liquidity, even in a mid-cycle scenario like we saw in early 2024, so we got that read when Bitcoin was around 51, 52,000. It topped, within a week or two at sort of 73,000. So it doesn't catch the top. None of these are going to catch the top, but it tells you when global liquidity, when the price is stretched versus global liquidity. And of course
that's how I think about this to explain to people is call it a 90% correlation roughly. It's when you look at what's the other 10%, it's often the fear and greed, the elements where the market gets over ahead of itself, which is what you're picking up here is like the deviation from the trend versus liquidity, right?
Yeah.
So when it gets too obscene, people have taken too much risk. And then you've got other scores like leverage that then you would add on to that and say, yeah, and the leverage is built up and that's why we're in excess.
Yeah, exactly. So like, I probably should have said this from the outset. It's global liquidity, it's leverage and positioning, and it's unrealized profit.
It's broader than just deviation from liquidity.
Yeah. And that's important because that tells the other side of the story. So, okay, you can say that, okay, it's stretched in terms of where it is relative to global liquidity, but is there excessive leverage in the market? Like if that is also happening at that time, boy, oh boy, do you have a very strong signal for a looming market top, because derivative, like open interest and the factors that go into the leverage component or the derivatives risk score are very finely tuned to tops and also bottoms. So that plus also unrealized profit, which you can see on chain, come together in a very good way, like in terms of the confluence that you can get from it to give you sort of high probability zones of when things will top and bottom as well. So this was indicating, that in the early part of 2024, just a couple of weeks before we had that top, which I'll show you with the next chart on the derivatives one, was really driven by the derivatives market. It just was so excessive in Q1 with the launch of the ETFs that it was destined to correct. It only corrected by 25-30%, a pretty normal correction, but it did take about 6 to 7 months to unwind all that positioning. And then we also got an overvaluation read on the global liquidity risk score in December as well. And if you remember back then, you were talking about it, I was talking about it, like dollar was strengthening, like liquidity was tightening as we rallied very, very sharply into Christmas. And of course, then we had the fallout for the next sort of 3 to 4 months. So now where are we? We're at a score of 3. We are neutral. There is sort of that 40% rally off the lows of April is just the normal, the normal relationship playing out.
I have to say, what Jamie's built here is truly impressive, and I think it's an amazing tool that I will definitely be taking into consideration with my future trades. What it shows is that in 2024 and 2025, we've already hit 2 tops, and it was actually very, predictive and accurate with finding the general time frame in which that was happening. And right now it's showing that Bitcoin is actually trading at a level that is a pretty attractive buy between a 3 and a 2 on that chart, which is showing it's kind of middle of the pack. It has potential to have another leg up and hit a new all-time high here. And so overall, I think that's extremely exciting. And if that does indeed happen, well, listen, I think we're going to be doing really well. Now, with that being said, XRP also follows this trend line very similarly. Generally, it'll hit its all-time high just a little bit after Bitcoin does. And because Bitcoin just hit some new highs very recently, I do think that a lot of liquidity will be flowing into XRP. And that's precisely why I am actively trading XRP right now in anticipation for some pretty large moves, which I don't want you guys to miss out on. You can see the trades that I'm making when I'm making them completely for free. So there's literally nothing for you guys to lose by just joining into my Discord. The sign-up process to get in is super simple. You just have to sign up on one of my partnered exchanges through my referral link on the website, Bainix or BTCC, deposit at least $100 worth of any crypto, and then submit your email and exchange user ID, and boom, just like that, you can get access to my trades where, I've had certain months where I was up over 400% on my trades. Absolutely insanity. And I do think we're going to be encountering that very soon again, likely towards the early July, mid-July. I do think that's going to happen. So you have a little bit of time, but get in there. Don't waste any time at all, guys. And please note, nothing I say in these videos is financial advice, but if you like the content, please like, subscribe, and join the Discord or the Telegram. Link for my website to get in there down below. Peace out.